Something snapped quietly, not with a crash, not with a headline. More like the sound of a cable under tension finally giving way somewhere behind the walls. You didn't hear it because you weren't supposed to. You were watching the wrong screen. Stocks kept going up. Bonds stopped playing along. That's the break. For decades, the relationship was simple, almost elegant. When growth slowed, bonds rallied. When risk rose, yields fell. Equities panicked, bonds reassured. The system breathed in and out like a living organism. Pain in one asset class meant relief in another. Diversification worked not because it was clever, but because the system itself was coherent. That coherence is gone. This is not a cycle. This is a fracture. Look at what just happened and tell me it makes sense under the old rules. Inflation cools, at least on paper. Central banks hint at relief, growth shows fatigue. Equity markets cheer like they've been absolved of all past sins. And bonds? Bonds sit there, unmoved, demanding higher yields, refusing to provide cover, refusing to validate the story. That is not noise, that is refusal. The current event everyone keeps mislabeling as technical is simple. The bond market no longer believes the future is stable enough to lend cheaply to it. That's it. Strip away the jargon, the curve talk, the models, the television debates. Bonds are saying, I do not trust what comes next. That changes everything. Because bonds are not about optimism. They are about promises. And a promise only has value if the future that honors it looks predictable. Right now, the future looks anything but. The paradigm that broke is the idea that monetary policy can always smooth reality. That rates are a lever, not a consequence. That debt can grow faster than the real economy indefinitely, without demanding a higher price. That belief held the system together for 40 years. It is now dissolving in real time. You see the evidence everywhere once you stop listening to the narrative and start watching the plumbing. Yield curves refuse to normalize. Long-end rates stay elevated no matter how many dovish syllables are uttered. Auction demand weakens quietly, then recovers only with concessions. Term premia reappear like ghosts that models said were exercised forever. These are not anomalies. These are stress fractures. And insiders see them. They see them in how duration risk is suddenly treated like radioactive waste. In how balance sheets are shortened, not lengthened. In how liquidity is hoarded rather than deployed. In how supposedly risk-free assets now require explanation. When the people closest to the system stop behaving as if the system is safe, you should pay attention. The crowd doesn't, because the crowd is trained to look at stocks. Stocks are emotional instruments. They trade belief, hope, future narratives. Bonds trade arithmetic. They trade math under constraint. When the two disagree, it means belief and arithmetic have diverged. Arithmetic always wins, but it takes time. And in that time, illusions flourish. This is where geography exposes the truth. New York and London are still arguing about valuation multiples and earnings growth. Shanghai is asking whether the collateral behind those promises actually exists. The West trades claims on claims. The East accumulates things. Energy, metals, food, supply chains, physical control. That difference didn't matter when trust was abundant. It matters when trust becomes scarce. Paper markets can stay calm far longer than physical systems can stay stretched. You can print liquidity. You cannot print copper. You can roll debt. You cannot roll depleted mines. You can suppress volatility. You cannot suppress thermodynamics. This is the physical squeeze expressing itself through bonds. People think the physical squeeze starts with empty shelves. It doesn't. It starts with higher yields, because yields are the price of time. And when the future looks resource-constrained, time becomes expensive. The West still pretends this is about inflation expectations. It's not. It's about capacity expectations. About whether future growth can actually service future promises without debasing them. Bonds are voting no. This is financial war in its least cinematic form. No explosions, just refusals. Refusals to lend cheaply. Refusals to accept long-term promises without compensation. Refusals to play the role they used to play. Banks understand this instinctively. That's why they look calm while fortifying. Capital rules aren't academic to them. Basel III isn't paperwork. It's a map of exits. Liquidity coverage ratios aren't safety measures. They're triage tools. Resolution frameworks are not hypothetical. They are scripts. Read the boring documents and you'll see the horror hiding in plain sight. Force majeure clauses expanded. Settlement hierarchies clarified. Alternative performance quietly normalized. This is the system pre-negotiating its own failure modes. And equities keep rallying. Why doesn't the crowd see the break? Because media blindness isn't accidental, it's structural. Rising stocks are easy to explain. They feel good. They confirm identity. Falling trust in bonds requires uncomfortable questions about debt, deficits, and the limits of policy. So it's reframed as technical, temporary, a positioning issue. But bonds don't position emotionally, they position defensively. The old relationship between stocks and bonds was built on one assumption: that the sovereign issuer was credible, disciplined, and capable of absorbing shocks without debasing the unit of account. That assumption is now under stress globally, not because of one crisis, but because of cumulative exhaustion. Debt levels are no longer counter-cyclical, they are permanent. Deficits are no longer emergency tools, they are baseline. The bond market is not panicking. It's adjusting to a new normal where scarcity, not abundance, sets the tone. This is where the break becomes irreversible. Once bonds stop acting as a hedge, portfolios lose their anchor. Diversification becomes correlation. Risk migrates instead of dispersing. Calm in equities becomes deceptive, because there is no longer a stabilizer beneath them. That's why this matters more than any single rally or sell-off. This break means the system has lost its shock absorber. The crowd won't feel it immediately. They rarely do. At first, it feels like freedom. Stocks go up without fear. Dips are shallow. Volatility stays low. It feels like the rules have been suspended in your favor. That's always how fragility feels before it reveals itself. Inside institutions, the tone is different. Pension funds quietly reassess assumptions. Insurers adjust liabilities. Sovereign funds rebalance away from long-dated paper. None of this makes headlines. It shows up in custody flows and bilateral deals. In accumulation, not speculation. And again, the East understands this better than the West, because the East never believed bonds were sacrosanct. They were tools, temporary instruments in a larger game of securing resources and autonomy. When trust wanes, tools are discarded. This is why something breaking between bonds and stocks is not a market curiosity. It's a civilizational signal. It tells you that the era of painless debt is ending. That time now has a cost that cannot be legislated away. That the future is no longer assumed to be smoother than the present. The physical squeeze ensures this. You can refinance obligations. You cannot refinance physics. Silver cannot be printed. Gold cannot be diluted. Energy cannot be negotiated with. These realities are seeping back into financial pricing through the one market that cannot lie for long: bonds. Equities can levitate on stories for years. Bonds can't. They settle in cash. They demand closure. They expose fantasy. That's why the break happened there first. And once you see it, you can't unsee it. You start noticing how every policy response sounds recycled. How every reassurance feels louder than necessary. How calm is being marketed, not experienced. The system is not collapsing. It's shedding illusions. And that process is far more dangerous for those clinging to old relationships than for those willing to adapt. Something broke between bonds and stocks because the promise that connected them broke. The promise that the future would behave like the past, with better technology. It won't, and bonds know it. What comes after a fracture like this is never symmetry. Systems don't heal by returning to balance. They adapt by choosing a new bias. And when the bond market steps away from its old role, the entire structure tilts. The first thing to understand is that the future will not announce itself as the next phase. It will arrive disguised as volatility without explanation. One week, everything rallies together. The next week, nothing makes sense. Assets that should move opposite each other move in the same direction. Correlations snap, reform, then snap again. Commentators argue whether this is bullish or bearish, missing the point entirely. It's neither. It's transitional. There are three paths forward, and all three are uncomfortable. The soft version is not soft at all. It's a grinding repricing of time. Yields stay higher for longer, not because inflation is raging, but because trust never fully returns. Governments keep issuing. Central banks keep managing optics. Equities survive, but only nominally. They drift higher while purchasing power erodes underneath. People feel richer on paper and poorer in life. This is the quiet confiscation path. No crash, no panic. Just a slow recalibration where the future costs more than expected. The violent version is faster. Something fails to clear. An auction stumbles. A funding market freezes for a few hours that feel like days. Equity confidence evaporates because the safety net doesn't show up on time. Bonds don't rally. They sell off with everything else because the issue is not risk appetite, but solvency. This is when people realize diversification was conditional, not structural. The response is forceful, loud, and temporary. The damage is lasting. The third path is the one most people miss because it looks like an upside. Certain assets break away from the system entirely. They are no longer priced as investments, but as exits. They gap higher not because demand explodes, but because supply vanishes. Ownership becomes scarce. Access becomes political. This is not prosperity, it's stratification. All three paths share one feature: the crowd reacts late. Psychology always lags structure. First comes disbelief, then rationalization, then urgency. FOMO appears not because people want gains, but because they sense the window closing. The language changes. It stops being about price targets and starts being about allocation. Can I get some? Replaces, is it cheap? Cues form when trust breaks. Not dramatic cues with shouting, but orderly ones that feel almost polite. Waiting lists, delays, limits. These are the system's way of saying demand has exceeded trust, even if supply technically exists. Panic comes later, when people realize the cue is the market. By then, behavior shifts violently. People sell what they own easily to secure what they might not be able to get later. Liquidity becomes asymmetric. Things you assumed were liquid aren't. Things you never thought about suddenly are. This is when emotions peak, because the sense of control disappears. That's when philosophy stops being optional. Most people confuse ownership with exposure. Exposure is a contract. Ownership is a condition. Exposure depends on rules being honored. Ownership depends on custody being respected. In stable eras, the difference is academic. In unstable eras, it's everything. Sovereignty is not isolation. It's proximity. How close are you to what you rely on? How many promises stand between you and function? Every intermediary is efficient until it isn't. Every optimization carries an embedded assumption of stability. When stability is questioned, optimizations unwind. Freedom in this context is not wealth. It's not having to act under duress. It's not being forced to sell at the wrong time or buy at the wrong price because your options narrowed. The bond market is warning you about duress. It's telling you the cost of waiting is rising. This is where people make the mistake of asking for a checklist. They want to know what to buy, what to sell, where to hide. That instinct is understandable and dangerous. Checklists work in static environments. This is not static. This is a shift in how risk behaves. The better question is, where am I fragile? Fragility hides in assumptions. Assumptions about liquidity, about counterparty reliability, about policy competence, about global cooperation. The more your strategy depends on those assumptions holding indefinitely, the more exposed you are to this break. The advice here is not dramatic. It's almost disappointingly calm. Reduce duration in your life, not just your portfolio. Long promises are the enemy in a world where bonds are demanding a premium for time. Favor things that can be adjusted, moved, reallocated without permission. Avoid structures that assume benevolence from systems under strain. This doesn't mean abandoning markets. Markets will still function, money will still circulate. But the hierarchy inside the system is changing. Claims are losing status to control. Narratives are losing power to logistics. Watch what institutions do, not what they say. They are not positioning for a return to the old equilibrium. They are positioning for a world where access is uneven and rules are flexible for those who prepared. The East understood this before the West admitted it. That's why it accumulated quietly while the West debated theories. Geography matters because belief systems matter. One side believed in infinite elasticity. The other believed in limits. Limits always win eventually. This is not about fear. Fear leads to bad timing and worse decisions. This is about respect. Respect for constraints, for physics, for human behavior under stress, for history's tendency to repeat itself through different instruments. The bond market breaking away from equities is not a market call. It's a regime signal. It's telling you that the stabilizers are gone and the system will now oscillate more violently, even if the surface looks calm. You don't need to predict which week matters. You need to position so that no week ruins you. That means giving up some upside. That means accepting that not every rally is yours. That means being comfortable looking wrong in the short term. Prepared people always look wrong until they don't. The friendly advice is to stop trying to win the game that's ending and start learning the rules of the one that's beginning. That game rewards patience, custody, and adaptability. It punishes leverage, dependency, and blind faith in policy. Silence is a strategy here. You don't need to announce moves. You don't need validation. The best preparations are invisible. They look boring. They attract no attention. That's why they work. When the crowd finally notices that something broke, it will already be paying a premium to fix it. You don't want to be solving problems at market prices under emotional pressure. The bond market has already adjusted. It's charging more for time because time has become uncertain. That uncertainty will seep into everything else. Slowly, then suddenly. You can't stop that process. You can only decide whether you meet it prepared or reactive. Something broke between bonds and stocks because the future stopped looking smooth. The system is adapting. The question is whether you do too. Act quietly, think structurally, respect constraints, and don't wait for permission to protect your optionality.